Imagine sitting at your desk, opening the financial planning spreadsheet you've carefully constructed. Retirement plan at age 55, children's education fund. A mortgage that will be paid off in 15 years. Investment targets structured neatly. Everything seems reasonable. Everything based on sensible assumptions. Then within 6 months, all those assumptions collapse. Not because you made mistakes, not because you were lazy or undisciplined, but because the systemic foundation on which you built those plans completely crumbled. This isn't fiction. This is the reality faced by millions of people after the 2026 crash. And today, I'm going to explain why planning your future, an activity we've always considered rational and responsible, suddenly became a futile exercise. Part 1. When basic assumptions become invalid. Personal financial planning is built on a foundation of assumptions. Average inflation around 2-3% annually. Stock investment returns averaging 7-10% over the long term. Property values tend to rise. Income will increase as careers develop. Currency will remain relatively stable. These aren't random numbers. These are patterns observed over decades in modern economies. Financial planners use these figures. Online retirement calculators use them. Even AI chatbots giving financial advice use them. The 2026 crash destroyed every single one of these assumptions simultaneously. Let's start with inflation. In the United States, inflation that should have been 2.3% jumped to 8% within 3 months. But this wasn't ordinary inflation. This was stagflation, high inflation amid a contracting economy. Prices rose not because of strong demand, but because supply chains collapsed and currencies depreciated. In emerging markets, the situation was far worse. Turkey experienced 200% inflation in a year. Argentina surpassed 250%. Egypt, Pakistan, South Africa all faced double or even triple-digit price surges. Savings you accumulated over 10 years lost 70% of their value in 6 months. Now let's talk about investment returns. The classic assumption, stock markets rise an average of 7-10% annually over the long term. Long term became the mantra. Time in the market beats timing the market. All conventional advice said stay invested. But the 2026 crash erased 15 years of returns in 6 months. The S&P 500 index fell 45% from its peak. Emerging market indices fell 60%. If you started investing in 2010, you were back at square one. If you started in 2015, you were down 30%. Long term turned out not to be long enough. And this doesn't even account for currency effects. If you're an Indonesian investor who bought S&P 500 ETFs, you didn't just face a 45% decline in dollars, you also faced the rupiah depreciating 35% against the dollar. The combination created even deeper losses in local currency terms. Property, the investment considered safe and guaranteed to rise, also collapsed. Residential property prices fell an average of 35% in advanced economies. In some markets like Australia and Canada that were previously overvalued, the decline reached 50%. The house you bought with a 20% down payment in 2024 is now underwater. The home's value is lower than the remaining mortgage debt. You can't sell without taking massive losses. You're trapped with a depreciating asset and static debt. The assumption about income growth also shattered. Companies slashed salaries, bonuses were eliminated, promotions frozen. In an economy contracting 6.5%, companies focused on survival, not increasing employee compensation. If you were lucky enough to still have a job, you had to accept stagnant or even reduced wages. Unemployment jumped to 9% in advanced economies, 15% in emerging markets. But these official figures hide a worse reality: underemployment. People who were previously full-time are now part-time. People with high skills working jobs far below their qualifications. Software engineers becoming baristas. Marketing managers becoming freelance admins. Currency stability, an assumption we rarely even think about, also vanished. The dollar strengthened 40% against a basket of global currencies as a safe haven. This sounds good for Americans, but creates chaos elsewhere. Emerging market currencies fell 50-70%. The Argentine peso, Turkish lira, South African rand, all in freefall. If you had dollar-denominated debt, mortgages, student loans, business debt, your real burden suddenly doubled. $100,000 in debt that was previously equivalent to 1.5 billion. Rupiah is now equivalent to 2.3 billion rupiah. All the basic assumptions we use to plan our future, controlled inflation, positive investment returns, stable property values, increasing income, predictable currency, all became invalid simultaneously. And this is why planning became impossible. You can't plan when you don't have reliable assumptions. Garbage in, garbage out. If your assumption inputs are wrong, your financial plan outputs will be wrong too. Part 2, the collapse of time. Horizons. Financial planning is about time horizons. You save today for expenses tomorrow, next month, next year, or 30 years from now. You invest for retirement 25 years away. You pay a mortgage over 30 years. The 2026 crash destroyed our ability to think in long time horizons. Why? Because of extreme uncertainty. Under normal conditions, we can make projections with a reasonable confidence level. I don't know exactly what my investment return will be next year, but it's probably between 5% and plus 115%. The range is wide, but bounded. You can plan around this range. After the 2026 crash, the range of possibilities became so wide as to be almost meaningless. Next year's investment return could be plus 150% if there's a dramatic recovery, or 40% if the crisis worsens. Inflation could be 15%, or deflation could be 5%. Your currency could strengthen 20% or collapse 60%. When the range of possibilities is this wide, long-term planning becomes an exercise in futility. You can't make sensible retirement plans when you don't know whether your retirement assets will be worth half or double what they are now 5 years from now. The reliable time horizon shrank from decades to just a few months. People stopped thinking, how much will I need for retirement in 2050? And started thinking, will I be able to pay rent next month? This isn't just a psychological phenomenon. It's a rational response to extreme volatility. In highly volatile environments, focusing on the short term is a sensible survival strategy. Long-term planning requires a level of predictability that no longer exists. Look at what happened to corporate planning. Companies that usually made 5-year strategic plans could now only plan quarter to quarter. CFOs couldn't make reliable revenue forecasts for next year, let alone 5 years. They operated in reactive mode, not proactive. If large corporations with teams of analysts and access to the best data can't plan long-term, how can you as an individual do it? The collapse of time horizons also destroyed the mechanism of saving for long-term goals. People saving for house down payments suddenly used those savings for living expenses when they got laid off. People investing for children's education were forced to liquidate investments at massive losses to pay medical bills. Goal-based financial planning, saving for specific goals with specific timelines, became impossible when goals kept changing and timelines became irrelevant. When you're in survival mode, all long-term goals are postponed indefinitely. Part 3. The failure of diversification as strategy. Don't put all your eggs in one basket. This is the most fundamental investment advice. Diversification protects you from risk. If stocks fall, bonds rise. If domestic performs poorly, international does well. If equities fall, real estate or commodities balance things out. The 2026 crash proved that traditional diversification fails completely in systemic crises. Why? Because under normal market conditions, asset classes have different correlations. Stocks and bonds usually have negative or low correlation. When the economy is strong, stocks rise, but bonds fall. When the economy is weak, stocks fall, but bonds rise as a safe haven. Diversification works because asset classes move independently. But in systemic crises, all correlations move toward one. All asset classes fall together. Stocks down 45%, bonds down 30%, real estate down 35%, commodities collapse. Even gold, the ultimate safe haven, fell 20% in the initial phase due to forced liquidation. The 60-40 portfolio considered balanced, 60% stocks, 40% bonds, provided no protection. This portfolio fell 38%. A more aggressive 80-20 portfolio fell 42%. A conservative 40-60 portfolio fell 32%. All experienced devastating drawdowns. Geographic diversification also failed. You invest in the US for stability, in China for growth, in Europe for developed market exposure, in emerging markets for higher returns. But the 2026 crash was global. The US down 45%, Europe down 48%, China down 52%, emerging markets down 60%. There was nowhere to hide. Even alternative investments like hedge funds, private equity, and venture capital didn't provide diversification benefits. Hedge funds that were supposed to hedge against downside faced redemption pressure and forced selling. Private equity valuations fell 40-50% on a mark-to-market basis. Venture capital funding dried up completely. Cryptocurrency, which many positioned as a diversifier or hedge against traditional finance, fell 75%. Bitcoin dropped from $95,000 to $23,000. Ethereum down 80%. Crypto turned out not to be an uncorrelated asset. It was more volatile than traditional stocks. The collapse of diversification as a protective strategy created a crisis of confidence in the entire framework of modern portfolio theory. The theory taught in every finance class, which forms the basis of robo-advisors and target date funds, turned out not to work when you needed it most. This isn't to say diversification is useless, but it shows that diversification protects you from idiosyncratic risk, not systemic risk. If one company goes bankrupt, diversification protects you. If the entire financial system collapses, diversification isn't enough. Part 4. The illusion of control and agency. One of the most psychologically devastating aspects of the 2026 crash was how it exposed the illusion of our control over our financial futures. We're taught that we have agency. Work hard, invest wisely, live frugally, plan carefully, do these things and you'll be financially secure. This is a fundamental belief in modern capitalism. Your financial future is in your hands. The 2026 crash showed this is only partially true. You could do everything right and still lose everything due to forces completely beyond your control. Take someone we'll call Andy. Andy was a model of financial responsibility. He saved 20% of his income. He invested disciplined in index funds. He bought a house with a healthy down payment, not a risky zero down payment. He had a 6-month emergency fund. He followed all the best practices. The crash hit. His investment portfolio fell 50%. His house went underwater by 30%. He got laid off from his engineering job. His emergency fund ran out in 4 months because living costs were higher than expected, and it took longer to find work. He was forced to sell assets at massive losses to survive. Andy did everything right, but his outcome was the same as people who didn't plan at all. Maybe even worse, because people without assets didn't experience capital losses. This creates profound disillusionment. If doing the right thing doesn't protect you, why bother planning? If your outcomes are determined by macro forces beyond your control, why not just live for today? The collapse of the sense of agency destroyed motivation for long-term planning. Why save for retirement if the system can collapse? Why invest if markets can fall 50%? Why pay a mortgage if property values can drop 35%? This is a tragedy because planning remains important. But after the 2026 crash, an entire generation lost faith in planning as a tool. They saw parents and mentors who planned carefully still get wiped out, and they concluded that planning is futile. Part 5. When institutions can't be trusted. Personal financial planning doesn't happen in a vacuum. We depend on institutions, banks to hold money, brokerages to invest, insurance for protection, government for safety nets. The 2026 crash destroyed trust in these institutions. Start with banks. In Europe, several major banks experienced runs. Deutsche Bank saw depositors withdraw $80 billion in 2 weeks. Credit Suisse, already troubled, collapsed completely and had to be nationalized. Barclays, BNP Paribas all experienced massive stress. In emerging markets, the situation was worse. Local banks in Turkey, Argentina, Pakistan faced insolvency. Deposit insurance schemes proved insufficient. People lost life savings. Trust in the banking system shattered. Even in the US, regional banks experienced stress. First Republic, Silicon Valley Bank 2.0, PacWest all faced deposit flight. Although FDIC insurance protected deposits up to $250,000, the claims process took time. Businesses with deposits above the limit experienced losses. When you can't trust that your money is safe in a bank, how do you plan? You have to hold cash, but cash is eroded by inflation. You're caught between bank risk and inflation risk. Brokerage firms also experienced stress. When markets crashed 45%, some brokerages faced their own margin calls. Trading was suspended for several days. You couldn't access your account. You couldn't sell even if you wanted to. Total illiquidity. Insurance companies, which were supposed to provide protection, faced solvency issues. Life insurance policies with investment components experienced value collapse. Annuities promising fixed income were threatened with default. Trust in insurance as a risk mitigation tool was destroyed. Even government safety nets proved insufficient. Social Security in the U.S. faced funding pressure earlier than projected. Pension funds experienced massive underfunding as asset values collapsed. Promises made couldn't be fulfilled. In emerging markets, government pension schemes collapsed completely. Argentina's pension system was raided to cover government deficits. Turkey's Social Security fund went insolvent. People who contributed for decades didn't receive the promised benefits. The destruction of trust in these institutions wasn't just a financial problem. It was a social trust problem. When institutions that are supposed to protect you fail, the foundation of economic planning collapses. Part 6. Information fragmentation and contradictory advice. In the chaos of the 2026 crash, people sought guidance. They looked for experts to explain what was happening and what to do. But they found a cacophony of contradictory advice. Financial advisors themselves were confused. Their models, based on historical data and mean reversion assumptions, were useless in a completely unprecedented environment. Advisors who were usually confident now gave hedged advice that was essentially meaningless. It depends. We need to see how the situation develops, diversify but be cautious, invest for the long term but protect capital. Traditional media provided narratives that constantly changed. One week they said, buy the dip, markets always recover. The next week, this time is different, get out while you can. This informational whiplash made it impossible to form a coherent strategy. Social media made the problem worse. Twitter X was flooded with financial influencers, each promoting different agendas. Crypto Bros said, this is why you need Bitcoin. Goldbug said, this is why you need precious metals. Doomsday Preppers said, this is why you need guns and canned food. Each narrative had elements of truth, but none provided a comprehensive framework for decision-making. People were drowning in information, but starving for wisdom. Algorithmic trading and AI-driven advice also failed. Models trained on peacetime data didn't know how to handle wartime volatility. Robo-advisors that automatically rebalanced portfolios ended up buying high and selling low in whipsaw markets. Algorithms designed for efficiency created disaster during crisis. Government communication was also contradictory. The Fed said, "We will do whatever it takes," but congressional gridlock prevented fiscal response. The ECB promised support, but German opposition limited action. Central banks in emerging markets were caught between defending currencies and supporting growth. They couldn't do both. In this environment of fragmented and contradictory information, individuals couldn't form coherent plans. Every source said something different, every expert had biases. There was no consensus view that could serve as an anchor for planning. Paradoxically, information overload created decision paralysis. When you have too much conflicting information, it's easier not to make decisions at all. You freeze. And during a crash, freezing usually means you take losses by default choices, not active strategy. Part 7. The breakdown of intergenerational transmission. One of the most tragic aspects of the 2026 crash was how it destroyed the transmission of wealth and knowledge across generations. Previous generations, baby boomers and Gen X, experienced earlier crashes. 1987, 2000, 2008. They recovered. They learned lessons. Invest for the long term. Don't panic sell. Markets always come back. They passed this wisdom to younger generations. But the 2026 crash was different in magnitude. This wasn't a correction or recession. This was a depression. And the lessons from previous crashes, stay invested, don't panic, turned out to be devastating advice. Millennials who followed this advice, stay invested, buy the dip, experienced portfolio losses of 50% plus. They were already dealing with student debt, high housing costs, stagnant wages. Now their investments were also destroyed. They looked at the parents and mentors whose advice they trusted and they felt betrayed. Gen Z, just starting to invest, experienced baptism by fire. Their first experience with markets was a massive crash. This will scar them permanently. Research shows that people who experience market crashes in their early investing years become risk-averse for life. An entire generation will underinvest for decades because of this trauma. Wealth transmission was also disrupted. Baby boomers planning to pass wealth to their children saw estate values collapse. Houses that should have been significant inheritances were now underwater. Retirement portfolios that should have supported them and could be bequeathed were now insufficient even for their own needs. Some retirees were forced to unretire. They returned to the workforce in their 70s because retirement funds weren't sufficient. This created competition with younger workers for limited jobs, creating intergenerational tension. Worst of all, knowledge transmission failed. The younger generation lost trust in advice from the older generation. They said long-term investing would be safe. That was wrong. They said diversification protects. That was also wrong. Why should I listen to them? This created a vacuum where the younger generation had to figure out everything from scratch without the benefit of accumulated wisdom. But they're figuring this out in an environment far more hostile and unpredictable than what previous generations faced. Part 8. Psychological scars and behavioral changes. The 2026 crash didn't just destroy wealth. It destroyed the psychology around money and planning. Financial trauma is a real psychological phenomenon. People who experienced severe financial loss exhibited symptoms similar to PTSD, intrusive thoughts, avoidance behavior, hypervigilance, emotional numbing. They constantly worried about money even when their objective situation was stable. This manifested in behavioral changes that made planning impossible. People became extremely risk-averse to an irrational degree. They kept all money in cash despite inflation eroding value. They refused to invest even in relatively safe instruments. They were paralyzed by fear of loss. Conversely, some people developed the opposite reaction, extreme risk-taking. I've already lost everything. What's the point of playing it safe? They gambled on crypto, options, leverage trading. This was desperation behavior, not rational planning. The relationship with money changed fundamentally. Pre-crash, money was a tool for achieving goals. Post-crash, money became a source of anxiety and shame. People didn't want to discuss finances, even with spouses or family. Financial planning conversations triggered panic attacks. Trust in institutions, in experts, in the system was destroyed and extremely hard to rebuild. Once trust is destroyed, even when conditions improve, people remain suspicious. They expect the next crash is always around the corner. They can't commit to long-term plans because they expect disruption. This creates a vicious cycle. Lack of planning due to trauma leads to poor financial outcomes. Poor outcomes reinforce trauma and the belief that planning is useless. The cycle repeats. Social comparison also became toxic. Pre-crash, social media was filled with humble brags about portfolio gains and financial wins. Post-crash, there was a combination of silence, people ashamed to discuss losses, and schadenfreude, satisfaction seeing others also suffer. Most concerning was learned helplessness. This psychological concept describes how after repeated negative experiences beyond your control, you stop trying to improve the situation even when improvement is possible. Why bother saving? The system will crash again. Why invest? I'll just lose again. Why plan? It won't matter anyway. Learned helplessness on a societal scale destroyed economic dynamism. When a significant portion of the population gives up on planning and self-improvement, economic recovery becomes much harder. Conclusion: living in permanent uncertainty. So we return to the original question. Why did planning your future become impossible after the 2026 crash? Not because planning as a concept became useless, not because people became lazy or irrational, but because the preconditions necessary for effective planning were destroyed. Planning requires predictability, not perfect predictability. We know the future is always uncertain, but bounded uncertainty, a manageable range of possibilities. The 2026 crash destroyed this bounded uncertainty. Now anything seems possible, from rapid recovery to prolonged depression. The range is too wide for meaningful planning. Planning requires reliable institutions. Banks to save with, markets to invest in, insurance for protection, government for safety nets. The 2026 crash proved these institutions can fail. Once trust is lost, it's extremely hard to rebuild. Without institutional reliability, individual planning becomes extremely difficult. Planning requires time horizons. The 2026 crash collapsed time horizons from decades to months or even weeks. When you're operating in pure survival mode, long-term planning is impossible. You optimize for now, not for the future. Planning requires agency, the belief that your actions matter. The 2026 crash showed that macro forces beyond your control can override all your decisions. This creates a profound sense of helplessness that undermines motivation to plan. Most importantly, planning requires hope. Hope that the future will be better. Hope that your efforts will pay off. Hope that the system fundamentally works. The 2026 crash shattered hope for millions of people. Living in permanent uncertainty is psychologically exhausting. Humans need structure, patterns, predictability. We need to believe we can influence our outcomes. When this structure is lost, we drift. We become reactive instead of proactive. We survive instead of thrive. This is the true cost of the 2026 crash. Not just trillions in lost wealth, not just years of wasted economic growth, but the loss of ability and willingness to plan for the future. An entire generation will be scarred. They will approach money, investing, career, and life choices with caution and fear that may not be proportional to actual risk. They will underinvest, undersave, underplan. And in doing so, they may create a self-fulfilling prophecy. By not planning adequately, they guarantee poor outcomes. Breaking this cycle will require more than just economic recovery. It requires rebuilding trust, rebuilding institutions, rebuilding a sense of agency, rebuilding hope. And all of that takes time, decades, not years. For now, for millions of people, future planning isn't about spreadsheets and compound interest calculations and retirement target dates. It's about next month, next week, even the next day. And that's why planning your future became impossible after the 2026 crash. Not because the future doesn't exist, but because we lost the ability to see it, to trust it, to prepare for it. The tools of planning, assumptions, models, projections, are all broken. The institutions that support planning, banks, markets, governments, are all compromised. The psychology that enables planning, hope, agency, trust is all shattered. What remains is uncertainty, permanent, pervasive, paralyzing uncertainty. And in uncertainty like that, planning becomes not an act of rationality, but an act of faith. Faith that somehow, despite everything, the future is still worth preparing for. For some people, that faith still exists. They will rebuild, they will plan again. They will find new frameworks, new assumptions, new ways to navigate uncertainty. But for many others, that faith is lost. And without it, they're adrift in the present, unable to imagine the future, let alone plan for it. And that is the most tragic legacy of the 2026 crash.